I recently came across a portfolio strategy that's been making the rounds. 4 investments, no bonds, and 20% in gold. And honestly, parts of it I really like. But there's a couple things that I would push back on, especially if you're just getting started. So let's get into it. Hi, if you're new here, my name's Charlie. I hit 7 figures in net worth by age 35, and I built a multi-6-figure investment portfolio from zero with no prior investing experience and no expensive financial advisor. So if you want to learn how to do the same, follow along. The portfolio looks like this: 50% in the S&P 500, 10% in international stocks, 20% in gold, and 20% in what the creator calls a opportunity bucket. This would be things like REITs, Bitcoin, commodities, whatever you believe in. The 50% S&P 500 foundation, totally agree with. This is exactly what I have. I actually keep 60% of my portfolios in the S&P. This means that you don't need to pick stocks. The index does it for you. It's always holding the strongest ones and automatically removing the weakest ones. Example of this would be VOO or SPMO or SPY, and you can get this at any regular reputable brokerage. Skipping bonds for your safe allocation, I also totally agree with this, depending on where you're at in your retirement and investing journey. Bonds sound safe, but right now when inflation is running hot between 3 and 4%, bond return doesn't keep up. You're losing purchasing power quietly and quickly, and to me, that doesn't equal safety. Now, here's where just me personally, my philosophy starts to diverge a little bit. Gold is a real store of value. I don't think anybody's going to argue that. But 20% is a significant chunk, and gold doesn't compound, doesn't pay dividends, and it doesn't grow earnings. It just holds value. I'm not saying don't hold any gold at all, but if you're in your 30s and 40s like I am, trying to build long-term wealth, that's 20% that's sitting in gold isn't compounding in the market for the next 20 to 30 years. My take, if you want gold as a hedge, that's totally fine. Maybe 5 to 10%, it does the job you want it to without giving up much growth. And the 20% opportunity buckets, crypto, commodities, individual stocks, I understand the appeal, but for a beginner, this is where I would pump the brakes because calling it an opportunity bucket makes it sound intentional. But for most people just starting out, I know like myself included, it's just a guessing game. But let me explain. My investing philosophy is built on the Bogleheads approach, which is boring, passive, and investing in low-cost, broad, diverse index funds. Not because I don't think you can find great individual stock picks, because you can, and I've done it, but because the research is pretty clear. Most people, including professionals, don't consistently beat an index fund over the long term. I'm talking 20, 30 years. Here's how I would simplify this portfolio even further, especially if you're a beginner investor. Start with a 3-fund core. Fund 1 is your S&P 500 or total US stock market fund, a small international allocation for global exposure, and a growth ETF if you want a little bit more upside. That's it. Automate it, don't touch it, and let time do the heavy lifting for you. Now, if you do have a strong conviction into gold or crypto or something else, that's totally fine. But my advice would be to keep it small, keep it intentional, and make sure you actually understand what you own. Because the best portfolio isn't a clever one, it's the one that you can understand enough to stick with it when things get uncomfortable. And trust me, they will. Make sure you follow for more calm investing content. No hype, no noise. We're just building quiet wealth over here. And if you want to go more in depth, you can sign up for my free weekly newsletter, which is linked in my bio.